All right, good afternoon, everyone. Money Show would like to welcome David Phillips and Todd Phillips, founders of Estate Planning Specialists. Today, they will show you a groundbreaking solution to protect yourself from one of the two biggest risks during retirement. David and Todd, thanks so much for being here. The floor is all yours.
Hey, it's Mark. Thank you so much for that introduction. It's great to be here and great to participate with all of your listeners in reference to what we believe is a crisis in the United States and something that we need to actually take a vigilant approach to solve this. So as individuals, we have a responsibility and certainly a fiduciary responsibility to take care of this. So Todd, tell me just a little bit, I'm going to kind of turn it over to you right now on this end of it. Have you actually had an experience with long-term care?
Well, I have, maybe not quite the degree that you have, but definitely both sides of our family. Our grandpa had Alzheimer's, grandma was in bed for a good 5 years. And that's why we felt this was such an important topic in the financial planning model, estate planning, because we've seen what can happen and how it happens.
And, I firsthand have seen this, as Todd said, but one of the things that I feel responsible is that since most everybody that's listening today has had a long-term care experience, you've actually had this impact in your life somewhere or another, of a friend, a family member, and what I've seen is in the financial plans that we've been doing, the estate plans we've been doing, is that a lot of people paint themselves into a corner, and they really have no alternative other than to use their own money to take care of themselves. And a lot of families don't like that. They don't want to do that, and as a result, they take care of the family member as long as they possibly can, which drains them in a lot of ways. I will talk about today, but we are living this experience, especially the boomers, as we take care of our families. So let's talk about what we want to talk about today. We've got a couple talking points that we really want to tell you what we're going to tell you. So the first thing is we want to talk to you about how to leverage pennies today to generate tax dollars for your possible future care. Leverage is a key element in all financial planning, and in the financial world itself. You really want to use someone else's money as much as you possibly can, and we're going to talk about how to take a penny today and create a dime tomorrow, or a dollar today and create $10 tomorrow. So that's number one talking point.
All right, this next one we think is really important. We've seen too many times where the long-term care policies that people have aren't covered the situation that they're in, and most of the time it's family members that are trying to provide the care. We want to show you a plan where your family members can get paid to be your caregiver.
And not just to be your caregiver, but you know what? If you wanted to, in the plan we're going to talk about today, if you wanted to have your kids come over or your grandkids come over and play bingo with you and pay them for that, I mean, this will allow you to, once the benefit's triggered, you'll be able to get the money and do whatever you please with it. Obviously, the intent is to use it for your care, but if you don't need it for care, my dad had Alzheimer's for 7 years. He didn't actually need physical care until about the last 2 years of his life. At that point in time, we needed financial assistance. But prior to that, and that's a trigger mechanism. That's a trigger, and so he would have actually received money and been able to use that for a number of things, even travel. When I was on a cruise last week with Mark Skousen at the Global Financial Summit, there were several in that cruise that you could tell had dementia or Alzheimer's or whatever, and they were on a cruise with their spouse. So that's pretty cool, I thought.
Kind of cool.
We're also going to talk about the difference between reimbursement and indemnity, and that's what we were just alluding to. The benefit where you have the cash, you do what you please, is called indemnity. A reimbursement is where you actually have a physical expense, and then you're reimbursed for that. And only professional caregivers are on the reimbursement plan. So if you look at your plans today that you may have, look and see if it's reimbursement, and understand that there's a difference between reimbursement and indemnity. And indemnity, we feel, is superior. We're going to also introduce you to the absolute best long-term care plan in the country today. And that's, yes, it's our opinion, but we have done extensive studies on the market. We know where the best plan is. We're not going to tell you the name of it. You're going to have to call us to ask that. But we're going to tell you, we're going to describe it to you. Interesting enough, though, over the last just 30 days, on November the 1st, actually, the #1 producing carrier for long-term care plan in the country for the hybrid plan that we're going to introduce you today, just had a rate increase by 20% across the board. The plan that we have been recommending for the last year and a half, 2 years, actually provided more benefit than the #1 producing plan in the country. Now, with the increase of 20% on that plan, the plan that we're recommending is even sweeter. So those are the talking points that we want to cover. And now let's just talk about, just briefly, some statistics. And I know some of you have heard these before, but we're going to hammer through them pretty fast. But do you know that 8 in 10, that's 80% of all women, will need long-term care? Now, my mom's 93. She's still kicking. She doesn't need long-term care at this point in time. But my mother-in-law, as Todd said, for the 3 years straight up in bed all the time. So 80% will need care. If you're married and you're over 65, there's a 91% chance that one of you will have a long-term care event.
Yeah, we thought this was pretty shocking that every 68 seconds someone develops Alzheimer's.
Now, that's what my dad had. I'm taking ginkgobola, and I'm trying to do everything I can not follow in my dad's footsteps, because it was pretty devastating for our family. And this guy was the life of the party.
Stand-up comedian.
Yeah, and he lost it. He lost all of those skills and abilities, and to see the shell of the man that he was at the end was pretty sad. But the interesting thing is the average life expectancy with Alzheimer's is 4 to 8 years. Now, that is a trigger mechanism for the plan that we're talking about today. So if you can't do 2 of the 6 activities of daily living, or you're cognitively impaired, you trigger the benefit, and you actually start receiving cash. And the cash is tax-free. 1 out of 9 Americans today that are over 65 are walking around with Alzheimer's. That's pretty significant. So that's anyway.
Pretty common, yeah.
So with the average expenses of a private nursing home is $100,000, semi-private, and then actually even have someone come and stay with you 24/7 is the most expensive. These events can take a hit on your estate. Now, most of our clients have more than $100,000, $200,000, $300,000 in their estate. But the question is that where you want your money to go? Wouldn't you rather have your money go to your spouse or to your children or your grandchildren? And so no matter how much you have, our wealthiest clients get this because they understand the power of leverage. And we're excited to present this opportunity to you today on the solution to this long-term care crisis. So with a couple of other statistics, so the typical stay in a nursing home is 3 to 4 years for women, 2 to 3 years for men, with an average cost total of $357,000 for women and $267,000 for men. So you can see women actually do tap into it more because 80% of them will have a long-term care event in their life.
Yeah, and the plan we're talking about does price accordingly. It is a little bit more rich in benefits for men. You'll notice that when you get your illustrations.
Cool. The other thing that I've seen with long-term care. And again, as I said, we're living this. We're experiencing this. We all know this. This is happening to our family members. That 80% of those that need care actually are receiving it today. Now, this is today. This is an anomaly because it hasn't been this way forever. But they're receiving care from unprofessional and unpaid, non-professional and unpaid family members, family caregivers. 80%. So that's huge. So we need to plan for that. We need to understand that. And usually it's the spouse. And the spouse that takes care of a spouse is 6 times more likely to suffer from anxiety or depression just because of the strain it puts on them. 1 in 4 Americans age 65 will live into their 90s. So they're gonna have this care event. 4 in 10 Americans are or were caregivers. And last, I think it's kind of an important, 1 in 3 caregivers provide financial support to those they care for. So it's not just caring for them, it's actually providing for them, for making meals for them, taking care of them in that way. And so it actually not only puts stress on the family mentally, it also puts stress on the family financially. And the caregiver, if it's a family member, usually will not be able to work, or at least they have to cut back on their work schedule, so that impacts them financially as well. So we need to have a plan in place that this doesn't happen. We're not painting ourselves into a corner. So the question that we want to ask all our listeners today is, if you triggered a long-term care event today, just think about this. Which of your assets would you cash in first to take care of you? And I like to think of the coffee can in the backyard behind the oak tree. You throw in $100,000 in the coffee can, and you say to the kids, if I wake up tomorrow and I can't remember your names, the money's in the coffee can in the backyard. So what assets are your coffee cans? So let's look at that. Usually it's the lowest yielding assets, the ones that are easiest to liquidate, that you're going to turn to first for your care. That's your cash. So that's up there in the $250,000 cash equivalent.
And one thing we've seen, I know, Dad, you've been doing estate planning for 40 years, over 40 years.
45, yeah.
I've been doing about 20. We've seen the ravages that long-term care can have on a well-planned estate, well-planned financial plan. People are having to liquidate assets that they weren't ready to pay for their care, and it goes quick. It just burns through it so fast. So that's why we want to designate a portion and use that money, leverage it, like Dad said, the best we possibly can for your care, so that when that time does come, you're prepared.
So what are your options? What options do we have now? What options are available to us? Well, in other words, to take care of us, rather than have us use our assets. Well, a lot of folks think that the government will take care of us. They think that, because Medicare's there, it takes care of us. Well, we know firsthand through our Uncle Mike that 100 days you're in a facility, they boot you, no matter what your shape you're in, and that's for sure. That's an absolute. That's Medicare. Well then, but we've had clients saying, well, Medicaid takes care of us.
And in order for Medicaid to kick in, you need to be completely impoverished. Most states, $2,000 of assets, not counting your house and some other things, but they want you to spend down to only leave you with $2,000 to your name. So not much of an estate plan there.
Yeah, and that's not really what we want to do. We want to leave assets to our kids. So by spending down and giving the money to the government to take care of us and becoming absolutely as poor as a church mouse. And then you know what's crazy about that too, Todd, is that the care that you receive from a Medicaid assistant is not what you would normally want. I don't want average care, number one. But I don't want the kind of care that the government's going to force me into receiving.
You're probably not getting granite countertops.
No, I don't think so. So the other option is to get a standalone long-term care policy. And these have been around for quite a while. My parents, I secured a standalone policy when they first came out in the mid-'80s for my mom and dad. My dad never did use it because it required him to be in a nursing home. And my mom still hasn't needed it, so thank goodness. But my dad went through 7 years of Alzheimer's without any payment at all. So I'm not a big fan of standalone. I haven't been for a long time. I did it for my folks because that was the only option. But there are some other options that we're going to introduce you to today. But let's talk about standalone for a second and look and see exactly. First of all, they are expensive, use it or lose it proposition. So if you don't ever use it, you never receive anything back, period. It's like car insurance or homeowner's insurance. Pretty difficult to qualify right now. Only 25% of those that apply get it. The premiums can and will increase. Last year in Pennsylvania alone, one major carrier increased their premium by 130%, and that was approved by the State Insurance Commission. To me, that's ridiculous, and especially if you're on a fixed income. How can you swallow those kinds of increases? In 2000, let's look at the trend. In 2000, 700,000 individual long-term care policies were purchased. It was a pretty big deal. It was the biggest option, best option available. But last year, same with more people coming into the require long-term care, more boomers requiring long-term care. You'd think that there would be more, it would increase. You're 65 now and you go, holy smokes, I got to take care of this. Last year, only 60,000 individual long-term care policies were sold. So the trend, Todd, is downward. It's not something that we're seeing that's trending up. It's trending down. And there's a reason for that, because it is a use it or lose it proposition, and the premiums can increase. I think those are the main ones. So the next option is to be rich enough to pay for everything yourself or self-funded. But I'm here to tell you that even my wealthiest clients, even our wealthiest clients, Todd, and I know you've seen this a lot because that's what, you're heavily involved in financial planning with our firm. But even the richest, wealthiest clients, they understand that there's a better way than self-funding, because you put the money in yourself, like in the coffee can. Wouldn't it be better if you could take that money, the $100,000 that's in the coffee can in the backyard, and expand that significantly to be worth a lot more, to leverage it, to be worth 3 to 10 times more? So we're talking about taking that money and repositioning that money that's in that coffee can. Take it from your left pocket to your right pocket. In seminars that I do, I actually take a $100 bill and I go from my left pocket to my right pocket. So let's talk about this new long-term care solution. This is what we really want to focus on the rest of the time today, is the new solutions that are available. Most of them were created because of the Pension Protection Act of 2006, and a little known section in that act called Section 844. And what that does is that allows you to take money, again, from your left pocket to your right pocket and leverage that and create dollars from the pennies, dollars from pennies.
In something, just a little history, so they really got enacted in about 2010 is when you started to see a lot of these, they call them hybrid plans, where they were asset-based, putting up some kind of asset to get a multiple amount of long-term care. And they really started about 2009, 2010 is when most of them came in and became in law.
In vogue.
In vogue, yeah.
Popular.
And now they're even more popular today, and that's what's taken over the market share of the traditional plans, because it's a better model, and we'll go through that here.
Okay, well, we already talked about that. So the dollar can grow to $3 to $10, so that's the leverage that we're talking about. And I think probably the most important part of this is that if you, with any of these leverage care plans, if you are fortunate to dodge the long-term care bullet, so it's just something that you've avoided, you're in that 20% of the women and 40% of the men that never have a long-term care event, and you get to the end of day and you're there and you get up to St. Peter and you didn't trigger it. Whatever money is either in your account and the cash in the account, or a life insurance benefit is passed to the beneficiaries, and that money is a return of that money that you put into it. So it's like a return of premium. I've already alluded to the trigger mechanisms for the leverage care solution. They're the same trigger mechanisms that would be for Medicaid, except for being impoverished. And it's the same trigger mechanism for standalone long-term care, is cognitive impairment, so dementia, Alzheimer's, in any form of
And
that,
sundowner,
any derivative, sundowner, any form of that, that's a trigger mechanism. And or you can't do 2 of the 6 activities of daily living.
Yeah, which are eating, bathing, dressing, toileting, transferring, and maintaining continence. Those are the 6. Most long-term care policies will have this as the definition of triggering.
Right.
So know those things, and that's your basic things that if you are independent, what you can do, that's how they measure. Can't do 2 of those.
If you personally can't do it, you need help doing it.
Yeah, you need assistance doing these things.
Or you're cognitively impaired. Cognitive impairment is one by itself, so you don't have to do. Okay, so good. Okay, so let's talk about now this idea of leveraged care solutions. And by the way, we have a report that is available to you on our website about leveraged care solutions in general. So you can go ahead and get that report through our website. You can see our website's down below there, but we do have the website that's available to you that you can go and get that special report. And we explain these, but there's basically 3 kinds of leveraged care solutions. The leveraged care, or the long-term care annuity. And in this plan here, you basically take and you have money that you put into a deferred annuity, a single premium deferred annuity, and it will expand up to 3 times for your care. We really like this plan for those that have existing annuities that want to do a transfer of that annuity and that gain into a new plan. This is not our topic of discussion today. We can talk about that offline if you have an annuity and you want to talk about that, or you want to do that plan.
Right.
Okay?
Yeah, great for joint. That works good.
Really good for joint. For a husband and wife, they want to both do it in the same plan. The next one is actually what has really been called the hybrid long-term care. And a lot of folks, this has been on the market for about 15 years now. We really like it for those that want to leave a life insurance legacy to their kids or their spouse or their grandkids. We took this out for my wife Jane specifically for that purpose, because we wanted to have a life insurance legacy that was left to the kids. And what happens is that the long-term care benefit is extracted from the life insurance benefit. So if I'm insured for $500,000 and I trigger the long-term care, the same trigger mechanisms that I had, and I trigger that long-term care benefit, 2% of the death benefit is paid out to me. I become the beneficiary of my own life insurance policy. 2% is paid out to me tax-free, income tax-free, over 50 months. 2 times 50 is 100, so 100 is paid out. If I trigger it for 10 months, and let's say my benefit was, that death benefit was $500,000, and I triggered it for 10 months, and I was pulling down $10,000 a month, because that's 2% of $500,000. I would have pulled out $100,000 of the $500 in my family, and I die, my family would receive $400,000.
So you got to use the $100,000 for your care, and then they got the $400,000.
That's correct, and it's all tax free. So it's cool. It's really a good plan. We really like it, and a lot of people will gravitate toward that. This one here requires full underwriting, versus the annuity is an interview only to qualify. So okay, but the one we want to focus on today is what we call the return of premium long-term care. And the reason why we want to focus on it today is because if I want to really use leverage, if I want to use my dollar to create $10, this is where I'm going to go. It specifically focuses on care, but with a full return of premium, either to me or to my family, should I not trigger the benefit. But if I trigger it, I'm going to get a return of premium plus leverage it. And if I decide to bail on the plan in 5 years, I get all my money back. So that's what we want to focus on this one today. So what is return of premium long-term care?
And basically all we're doing was we're using dimes today for dollars tomorrow. We're leveraging our money today. So, and we'll give you some examples. It can be, like we said, over 10 times what you put in today for your long-term care tomorrow.
So what it does is it provides a benefit that you choose up front, a 48-month benefit or an 84-month benefit. We found that the sweet spot of this plan is 72 months, which is 6 years. That's the sweet spot. So we're going to focus on that as our focal point, because we found that that's actually the best payout. It does provide an immediate life insurance benefit, and depending on the plan that you take, one with inflation and one without inflation, it depends on what that life insurance benefit is. But in most cases, you put in $100,000, you transfer from your left pocket to your right pocket, you go grab the money out of the coffee can in the backyard, and you instead of having them find it for you after you die, you take it out now and you transfer it into there. There's going to be an immediate life insurance benefit, like a time and a half, like $150,000 for your family should you pass away the day after this policy goes into force.
Yeah, but again, it's not life insurance first. This is long-term care first. And you'll see that in the numbers here. But it does give you, after the 5th year, so starting of year 6, you have 100% of your money that you put in available
back
if you need it.
Yeah. It has really fabulous inflation benefit options that we really like, and most of our clients will incorporate and use the inflation option. And we'll talk about those here in a second. No medical exams required. It's an interview only. You do have to be in moderately good health to qualify. So you can't be in a nursing home. You can't have Alzheimer's or Parkinson's right now.
This is becoming a very, very popular plan, and they do give you some pretty good scrutiny. I mean, you have to qualify. There's no exam required, but there's a pretty solid interview that you'll go through, and we'll help you with that to prepare.
Now, when you qualify for the benefit, once you qualify, you qualify for the plan, and then you trigger the long-term care. It's an indemnity payout, so no receipts are required. So you're just going to get the check, and you decide what you want to do with it, or your family decides what they want to do with it. Again, pay the kids to come over and visit you, pay for their airfare to come and travel and visit you, and this is what it's your money.
You do have to periodically prove that you're needing care, but you can have your doctor do that, or they'll have some kind of thing that you have to. It could be every 90 days or every year, depending on what illness you have. But there is no receipts that they're going to require.
And of course, everything that you see, all your payout is tax-free, income tax-free. That's based on that Pension Protection Act, that 844 section. Yeah. So pretty cool. And you also have an option to not only do the single deposit, which frankly most people are doing, but what if I don't have $100,000 or $150,000 or $200,000 to transfer into this? All my money's tied up in my IRA. Well, you'll be able to for most ages, you can do multiple deposits, and we're going to show you some examples of that here in a second. Okay, right now, in fact. So we have a male, 60, and he has $100,000. And he says, okay, I'd like to look at what this would look like for me if I took the plan out without inflation. So immediately that $100,000 would be transferred into the plan, and the long-term care pool would be $481,000. That's almost 5 times what he put in, Todd. And that translates to $6,688 over 72 months, paid out tax-free. But we found that a lot of folks like to add the inflation rider to it. So what they do is their initial long-term care pool is less. It's not quite as much. It's $323 instead of $481. But look what happens by age 85. So when he's in that period of time when he may be triggering the long-term care benefit just by aging, the long-term care pool grows to 10 times actually 11 times than what he put in. So when we said 10 times, we're actually a little lean on that. It's actually 11 times what he put in for a monthly benefit of $13,000 a month, all tax-free. So basically, you'd make this transfer, your long-term care is taken care of. You just don't have to worry about it. So now, but I don't have $100,000, David. I've got my money tied up in the IRA. And I'm a 60-year-old female, and I want to transfer $100,000 over 7 years. In other words, I want what the 100,000 would give me, but I need to transfer it over seven years. So then what we do is we take money out of our IRA at the tune of $17,436. We would pay taxes on that money because it's been in an IRA. An IRA is always tax-free. Yeah. You take $1 out to buy a candy bar, you have to pay taxes on that IRA. But you transfer it out, and it's going to create an initial pool of $375,000 for the 60-year-old female with a 3% inflation for a long-term care benefit of $4,800 a month for 72 months.
Total pool in 20 years, $659,016.
And do you see how that happened? That happens because the pool started at $375, but it inflated by 3% every year. And what's cool is that inflation benefit takes place from day one, and it also continues if you trigger the benefit. So your monthly benefit may start out at $4,800, but it's not going to be $4,800 if you trigger. It's going to be 48 times whatever the compounding interest rate that you decided that was best for you. So the total pool in 20 years is 7 times, almost 6.5 times what you put in. It's pretty cool. And by the way, go back to that real quick. If I put in my first deposit of $17,000, I'm not only going to have the long-term care benefit, I'm going to have a life insurance benefit that we didn't put here on the slide, that we should have put on the slide. But that life insurance benefit is going to be somewhere around $150,000 immediate. That would go to my family. So what if I have these qualified dollars? What if I have money in and I want to transfer that money in now? I want to get it all transferred out instead of doing the 7 plan. I want to just transfer it out right now. Well, this is a cool strategy that a lot of folks have been implementing. So again, back to our 60-year-old female, she purchases if she has $100,000 of qualified money. So it's an IRA, 401k, 403b, any kind of qualified money that you've sheltered from taxes all the way through your life, or you have never paid taxes on this money. It's in your retirement plan. If you transferred $100,000 of that into a single premium immediate annuity, it would create $11,000 a year for 10 years. That's what it would create in income to you. Now you have to pay taxes on that because you're pulling it out of your IRA, but you wouldn't pay taxes on the $100,000. You'd pay taxes on the $11,000, so you'd piece it out over the years. And then you would take that $11,000 and you would acquire the ROP LTC plan based on 10 deposits instead of a single deposit. But look what it does. It creates an immediate pool of $423,000 long-term care benefit of $423,000, an immediate life insurance benefit of $141,000. So I only put in $11,000. I have $141,000 life insurance benefit for a female 60. But look what it does for my long-term care. It creates a pool 4 times the $100,000 that I transferred into the SPIA, and immediately, and a payout of $5,800 a month in long-term care. And this one is without inflation.
Right.
So I didn't do inflation.
We'll run, and everyone has a different situation, and we found a lot of our clients have most of their assets in IRAs or qualified money. So we do have to work with this. Ideally, you have cash that's sitting around, and like Dad says, in a can out in the backyard. But most people have a lot in IRAs, and so we can work with that, and we can definitely make it happen by a concept like this. And
I like the pie chart over here. What it's saying is just take a sliver of your money, so that's in your this here. Let's just say it's just whatever this case here would be like a $1 million estate, and he's taking 10% of it and transferring it into the SPIA that's creating this long-term care benefit that's 5 times what he put in. So pretty cool. So now, Todd, and I know you're really big on this return on investment, or ROI, or internal rate of return. I know this is kind of like your measure of everything, that if it's good or bad, and I know accountants use this as the criteria. Tell me a little bit about what's the internal rate of return of the return of premium long-term care?
It's a way, the internal rate of return calculation is basically, like Dad said, your return on investment, and it's going to use the time value of money and how it compounds. So what it's basically saying is, what other investment cash flow would we have to compare? What kind of rate of return would we have to get to equal the amount of benefits we're getting if we were to trigger and utilize the care benefits in this plan? So obviously, if you triggered the first year, that would be pretty rough on you, but you would get you'd have to get a 63% rate of return on investment to equal the benefits that you receive. Now, as time goes on, your IRR is going to go down, because your investment, your side pool investment, could have been compounding and growing too over that time. But as you can see here, you trigger in year 10, a 6-year-old, by the time he's 70, if he triggers, he's going to be needing a 14.51% rate of return
to equal the ROP.
And remember, this is tax-free dollars, so you'd have to be getting a tax-free return on your other source of funds. So this is all tax-free. You're 20, so now he's 80, get a 10% rate of return on investment to equal your 30, so 90, he'd get an 8.43. So it's a pretty decent rate of return on investment.
So what you're telling me is, in 20 years, I'd have to pull down like 13% from some other investment to equal the internal rate of return of this plan if I use it for care.
If compared with their taxes.
I mean, it's a no-brainer to me from an investment standpoint. If I look at it as pure investment.
Right.
And now I am taking my money out of use, my $100,000 in this case, the 60-year-old male. He can't use it for anything else, unless after 5 years, he says, well, I've got this opportunity over here, I want to pull it out. Then he can pull it out and use it for something else. That'd be kind of silly, because he'd have to pull down an internal rate of return of 13, 14% before taxes to equal the 10% here after tax.
We have a lot of clients that do self-insure, and they think that they're confident in getting a 12% rate of return throughout the years. And if you can do that,
yeah, but that means you can't have a 2001.
Right.
You can't have a 2008.
We're right now in the longest bull market since World War II, so we've had a pretty good run. We're due for some correction at some point. But if you're confident you can outbeat it, then great. More power to you.
Wonderful. Okay.
Well, we talked about the the other alternative is move your money into risk-free, other risk-free money, like the 10-year Treasury, which is paying 1.8 right now. Kind of put it into perspective.
Okay, so let's talk about what and we've alluded to some of these, but what are my funding options for the ROP LTC? Do a single deposit, multi-deposit. You could also do a 1035 exchange. So what if I have a life insurance policy right now that, let's say, and I saw one the other day with a client, he had $50,000 of cash in the policy. His death benefit was $100,000. So what's the net at risk for the carrier? $50,000. If he took that $50,000 of cash and transferred tax-free into the ROP LTC plan, he would expand his life insurance benefit would be greater. It'd be $150,000 instead of $100,000, but he would also have the long-term care benefit that he didn't have in the $50,000 that he currently had. He would have $50,000 for care with the old policy, but the new plan, he would have an expanded a minimum of 4 times. This guy was actually 5 times the initial benefit for care. So you want to look at, if you have old policies,
evaluate your policies. I mean, always you should do that at least every 5 years. Look at your policies.
So we can help you do that. Another thing is you can actually use some of your health savings account to pay for part of the premium for your ROP LTC if you're doing the multi-deposit option.
Yeah, if you have a health savings account, you don't think you're going to be using it, we can definitely take a look at funding with that source.
You can't use it all.
Yeah, there's some limitations for sure.
As there is a limit for the tax deduction, because you can actually get a partial tax deduction if you itemize for the ROP LTC.
There's a nice tax guide if you're interested in these options. The last one is, if you have a C Corp, there's some pretty unique strategies that you can implement, and get some nice deductions, probably the best of all if you have the C Corp. Again, contact us and we'll give you the tax guide and discuss if that's going to be a working option for you.
Cool. Okay, let's talk now for a second. We have a few minutes left here, Todd. I want to talk about the difference between reimbursement and indemnity. We kind of talked about it, but I think the key is you have to be a professional caregiver for the reimbursement to be reimbursed. So the kids can't take care of you. Your parents can't take care of you. Now you have 6 girls, right?
Mm-hmm.
I mean, you don't really need long-term care. You got 6 girls that maybe will take care of you sometime in the future, right?
That's my plan.
That's your plan. But the point is, you're in a situation where you could actually, if you do the cash indemnity plan, you could pay them to take care of you.
Right.
And I think that's.
I think we've helped a lot of clients with their long-term care and with their benefits and get their claims going. And it is a hassle to have the reimbursement. We have a lot of great reimbursement plans if this doesn't work for you that we can look to, and we do have a lot of clients on reimbursement. But there is some hoops that you have to jump through. You have to. A lot of times we found that you don't get along with the provider that you're getting. It takes 5 or 6 tries because they're actually coming in your home. They're pretty much becoming part of your family in these really trying times. So you need to get somebody that you get along with. Nice thing about cash indemnity is you spend it how you want,
Right.
on who you want.
Right.
And so that's in practice a pretty important feature.
Yeah. And again, no receipts required. So what in total, what do we have here? Well, we have a return of premium that is basically leveraging a portion of your assets today to create this security that you have where you do not have to paint yourself into a corner like your parents have, like your grandparents have. This is the responsible way to take care of your care. I firmly believe this, and with the indemnity benefit, it's even more responsible. So what are the 4 guarantees of the return of premium long-term care?
Yeah, so we talked about return of premium. You put your money in, you're guaranteed to get that money back if you need it in your 6 or at death benefit. Your death benefit will never be less withdrawal. Of course, if you take withdrawals for your care, but otherwise, if you're not needing care, your death benefit will at least be equal to the premium that you put in.
And then of course, then you have the long-term care benefit. And then what if I'm doing a multi-deposit option and I decide, like in the 50, I've signed up for the 10 deposit plan, and I get into it and I go, well, I want to use my money for something else. Well, you'll be able to receive a reduced paid-up benefit.
Right.
That's guaranteed.
Yeah, if you couldn't keep making payments.
And you got to understand, this is very critical. None of the plans that we've shown you today, none of the ROP LTC plans are speculative. Everything is 100% locked in and guaranteed. There's no how the market's doing, interest rates are doing. It has no impact on that at all. It's 100% locked in and guaranteed. But you do have to you have to qualify for this. So it's not just some, we have one client that owns a whole bunch of nursing homes, and he says, David, he took this plan out, and he goes, I need to get you into all my nursing homes and talk to the folks at the nursing home. Well, that's a little too late.
Yeah. We do get a lot of requests that we have 90-year-olds calling us that are in nursing homes, and it's kind of hard. But yeah.
So who is it for? It's for those that have assets over $500,000, we think. I mean, you can have less, but that's usually the best.
Yeah, you need to have some assets. Otherwise, if you're 100,000 or less, you're probably going to be using every bit of that money for your own income to live off. So this is for those that have more than that, or maybe if you have a pension to cover your income, this is that surplus so that you don't have to spend down this money.
Okay, and it's the good health. We talked about that. Next one is under 75 for the ROP LTC plan. Now, if you're over 75, 76, 80, we have other options for you, but the ROP LTC plan is for those that are under 75.
Yeah, we do have plans up to 85. But if we start getting a little less options at 80, and then they get limited at between 80 to 85.
Right. And again, for those that don't want to paint themselves into a corner, and it allows you to have actually investment diversification. So you're taking some of your money and you're putting it somewhere else. It's an uncorrelated investment. It has nothing to do with the market.
Right.
So you can go out and speculate all you want. This is guaranteed. This is going to be done. So don't worry about it. And of course, it has fabulous. So the next question is then why should you work with us? I mean, there are others that have this, obviously. I can honestly tell you that the number one plan in the country today, it just had a rate increase of 20%. It's still the number one plan in the country today, so it's still being sold. I don't get it. I don't understand how that could be, but they just don't know. People don't know, and I don't think that the guys that are selling it know that this other plan is available to them.
It is getting a lot more popular. This one
is. They had the one we're talking about had a 30% increase from November, just because the other one had that rate increase. By the way, once you're in, the premium is locked in. They can never jack it up, can never increase it. So, but why work with us? Well, I think I can, there are other guys that are really smart, they're really qualified, and they can do what we can do. But they haven't been recommended by Mark Skousen for 35 years. They haven't been recommended by David Eifrig, Retirement Millionaire, for 10 plus years. Bob Carlson for almost 30 years. Tony Sagami, Money and Markets, for as long as I can remember. And they're certainly not, they don't write for Weiss Education Services. So all of that together really puts us into a position where we are unique and we can help everybody in every state.
We put a lot of hours into studying these types of plans. We have pretty much every carrier out there that we can work with, and we've found that this one is the best, but it might not be the best in your particular situation. So let us do your analysis. And one thing I wanted to tell you that it is, I don't know if you knew, but November is Long-Term Care Awareness Month. Yeah, that little trivia you could tell your friends, Happy Long-Term Care Awareness Month. And that's why we chose to do this webinar with the Money Show, because we want people to be aware of their long-term care and take a look at that.
I wanted to be aware of the plan that had the increase, and this one didn't increase, and so it's kind of critical that they get into it now, because once they're in, they're locked in. It can never be increased. So what to do next? What should you do? Well, go visit ltc.epmeasy.com/ROP.
If you have, we tested our site yesterday. It was working great, but it used to be that if you typed in epmeasy.com/ROP, it would go right to where it's supposed to go to get the report. If you get there on our site, it doesn't work. Just put the epmeasy.com. It stands for Estate Planning Made Easy. Go to epmeasy.com. From there, you'll be able to see the place to request the report just from the homepage.
So what you're going to get is a free return of premium long-term care special report. So it's going to tell you everything that we told you in writing. The graphics are great, and it'll help you understand this a little bit better. And then the next step, once you get that, or you're already confident that you want to, you need to go on through that report, through that website, through the epmeasy.com/ROP website, and go in there. You have to do LTC dot, but go in there and work through that site. Go through the site, and there is a form in there that will allow you to request a specific example for you. Okay, or
call us.
Just call us.
Call us is fine too. Yeah.
Just call us and ask for Todd, myself, or one of the other staff members, and we can help you and give you an example that will, that we can show you exactly what it would look like for you based on your age, based on your health status. We can tell you if we think you can qualify.
We'll help you analyze it, if it's right for you. Give you several different examples, iterations, and maybe this isn't the right one, but we've got over 50 other long-term care options that you can look at.
Do we want to do any questions, or we just want to have them? I know there have been some questions that have come in, Todd. Are we good, or should we just?
I'm fine to do a couple of questions. I don't know how long are we.
Well, we really wanted to kind of keep this to 50 minutes. So
okay, well,
1 minute left.
Let's take a couple questions.
Okay. Do you have any questions there?
Yeah, we did have a couple of questions come in. One person was asking if they were recently diagnosed with cancer, would a provider cover them for LTC?
Yeah, recently diagnosed with cancer, I mean, skin cancer, you're okay, but typically they're gonna wait 5 years before we can get a plan. Some of the long-term care annuity plans are a little more generous, and we can usually get them qualified there. That's something I'll probably have to, it's more specific, what kind of cancer, how far it was along, and how it was treated. But yeah, usually.
But I think the key word there, Mark, is recently. It depends on how recently is and what kind of cancer it was. So
yeah.
Good question. All right, excellent. Thank you. A few people have asked a question, what insurance company is underwriting this plan?
You'll have to call 888-892-1102 to find out. We're not at liberty to say right now. But I'll tell you when you call me. So and we'll also reveal it to you when you request from the website for a special your own special illustration example. It'll all be there. But it's a highly rated carrier.
A+ rated,
They have a Comdex rating of 96, which is phenomenal out of 100. 96 out of 100. There's only a few companies that can say that. They've been in existence for over 100 years. So that is not an issue. This is not offered by Shifting Sands of Texas Life Insurance, or Blizzard
okay.
Life of Alaska.
Any other questions?
Just one more rolled in. Last one. Is there a minimum age to enroll?
Yeah, they just lowered that age to 35. So
30.
30. Oh yeah, 30. They just lowered it.
You're pretty on top of it if you're getting it at 30. I would say our typical range is 45. I mean, definitely we'll be happy to present options at 30. A lot of times there's some other ideas that we can look at for younger, but I'd say 45, 55 is and
the average age is in 65 probably.
Yeah, like 55 to 75 is really most common.
Well, terrific. Well, thank you all for listening today. And again, if you have any questions, 888-892-1102. Give us a call. Talk to Todd, David. We've got other staff members that can help you. And then go onto that website, ltc.epmez.com/ROP, and get that special report. Take a look at it. It's complimentary. You don't have to pay any money for it, and it'll go automatically to you. I believe all attendees are going to get an email from us in the next little bit that'll have all these links to them as well. But do you want to be proactive? Call us or go online, either one. Thank you so much for taking the time with us today. And Mark, thank you for the opportunity through moneyshow.com to present this webinar to your subscribers today and listeners. Appreciate it.
Absolutely. Fantastic presentation, gentlemen. Thank you very much.
Take care.
Thanks, Mark.
All right. Thanks, Anna. All right, everyone. Thanks for joining. And if you would like to see David and Todd, they will be at the Money Show Orlando, February 6th to 8th, 2020, at the Omni Resort at Champions Gate. Fantastic property. Be sure to pre-register today. You'll receive the latest updates as investing and trading experts are added, as well as in-depth workshops, special events will be added to the conference schedule. You'll get notifications of that as well. So again, thank you for attending, and I appreciate all of you. Good night.